What are some of the major changes businesses and households should anticipate in light of the new legislation come 2021? Shortly, we'll be joined by the Associate Director for Tax and Regulatory Services at KPMG, that is FCPA, Robert Oroiru. But before that, let's take a look at how the new law changes the tax bands on income. And if we could just go to the graphics here. Before COVID, these were the tax bands we were looking at. The first band of 12,298 shillings was being taxed at 10%. The next 11,587 was at 15%. The next 11,587 was at 20%, and it was being graduated that way until 47,000 shillings and 59 cents was being taxed at 30%. Crossing over to the situation we had in light of COVID, because the government decided to give us some relief. 24,000 shillings was taxed at 10%, and this is how we ended up with the relief for those who are earning 24,000 shillings and below, because definitely you have the personal relief of 2,400 shillings. The next 23,174 was taxed at 15%. The next 23,174 was taxed at 20%, and effectively anything at 70,348 was being taxed at 25%. You'll notice here there's nothing at 30% because income tax and corporate tax were reduced to just, were given the relief, rather I should say, from 30 to 25%. And finally, to look at what has now been passed and received the presidential assent, the first 24,000 shillings is being taxed at 10%, I should say. The next 8,333 is being taxed at 25%, and anything above 32,333 is being taxed at 30%. And I should clarify, these are monthly pay figures, not annual. Typically, we'd be looking at this in annual numbers, but for the ease of our consumption, let's just look at it in monthly terms. And this is where I welcome Robert Oroiru, who is the FCPA, Robert Oroiru, who is the Associate Director for Tax and Regulatory Services at KPMG. Robert, welcome on set.
Thank you, Julius.
These changes in the tax bands took me by surprise. Did you feel surprised as much as I did?
Well, there's two ways to look at this, Julians. Number one is that you have to look at the changes in the tax bands. So we no longer have 15%, we no longer have 20%. We only have 25 and 30. So that was a bit surprising. However, the fact that we are going back to the old rates, the pre-COVID rates, really did not come as a surprise.
Okay. And when you look at the situation around what this means for us with an income, when it comes to January and we're looking at our pay slips, what should we anticipate?
I think what everybody should anticipate, everybody who has got a pay slip, is that you will go back to what you are earning pre-April 2020. In other words, the amount of tax that you'll be paying come 1st January 2021 will be exactly like you are paying before April 2020.
And Robert, let me ask this. Let's take a scenario of someone who was earning, who earns 50,000 shillings in terms of gross monthly income. How was it pre-COVID? How was it in the COVID scenario? And how should it be now in the post-COVID, if I could call it, situation, in light of the new changes in the income tax bands?
That's a good question, Julian. So the way to look at it is, if you're talking about 50,000 shillings per month, before COVID, you are paying tax of roughly 7,400 shillings per month. During COVID, that number of the tax liability came down to about 4,000 shillings. So there was an additional 3,000 shillings take home that employees enjoyed. Come next month, which is January 2021, your tax liability will go back to 7,300. So the differential is minimal, if I could say that. So we've effectively gone back to where we were pre-COVID.
So Robert, just to be sure here, I should not expect that I'll be paying more tax than I was pre-COVID in light of the new changes?
Exactly. You shouldn't expect to be paying more. In fact, what Treasury has done, and I think that was a brilliant move on their part, they reorganized the bands to ensure that even though they have removed certain tax bands, the 15% and the 20%, you will effectively pay the same amount of tax. However, it's important for everybody to understand that you will now hit the top tax bracket of 30% at 32,000 shillings. Previously, as you've seen before, it was 47,000 shillings. So what the taxman has done is that he's brought more people within the 30% tax bracket, but effectively everybody will be paying the same.
Let's look at it this way, Robert. It reads to me like the government is on a mission to rope more people into the tax bracket of 30%. Is this a good or a bad thing? Because to me, it reads like a bad thing.
Well, I think it's really a good thing, because if you think about it, we heard that the Ministry of Education is going to be deploying about 19 billion shillings. Surely this money has to come from somewhere. So the more the merrier, I think. And I think what Kenyans need to do is now going forward ensure that these taxes are used wisely, because it is a painful process.
Talking about that this money has to come from somewhere, clearly you are hinting at the reversal of the relief measures. Let's talk about corporate tax for a while here. You know, for us who are in the individual income tax, 5% change might not look like a significant quantum, but when you look at corporates, if you take a company which, for example, has a turnover of about 5 billion shillings, 5% is not small. What are your expectations come January?
Well, companies have to actually think about the additional tax that they have to pay. And this especially comes in light of the reduced capital allowances. So effectively, what the taxman has done is that has gone back to the 30% corporation tax rate. However, reduced the number of expenses or allowances that you can claim against that taxable income. So we expect that corporation tax, barring any unforeseen economic downturn, we expect that corporation tax should perform much better than it has happened in the past.
Robert, one of the key changes we are anticipating come January 1st is minimum tax. Of course, this is a matter which has now been streamlined in the Tax Laws Amendment Act number 2 of 2020. Before that, there was a challenge in terms of the scripting and whether it could be enforceable. Now, clearly, that has been set aside. It is very clear. What are your expectations come January?
Well, what we expect is that minimum tax will come in, and as you correctly said, the drafting error has now been resolved. So companies will have to think about 1% of their turnover and pay that, either pay that or pay installment tax, whichever is higher. So what I expect is that companies will now start looking at their numbers every quarter, and that's one of the challenges of minimum tax, Julians, that every quarter you have to determine what your tax turnover is and then pay 1% of that. And when I say challenge, if you think about companies that have got at December year end, it means that for quarter one, by the time April rolls around, April 20th, you pay your 1% minimum tax. Not a problem. However, by 20th of June 2021, you'll be required to pay 1% of your 3 months turnover, but you don't know what your sales from June 21 to June 30th is. So I think that's one of the challenges, but I suppose that's a teething problem that will be addressed as we go along.
Before we take a break, Robert, one of the conversations now we are having is that now that minimum tax is low, can we have a conversation about potentially reducing the rate from 1% to say about 0.5%? Clearly, we've seen Nigeria take such a move in 2020 in light of the adverse economic situation. Don't you think there's an argument here?
Well, the parliamentarians did actually consider that, and if you look at the report that they tabled in Parliament, what they said was they thought that the 1% is fair. My own view is that 1% is a bit on the higher side, especially if you think about Nigeria, like you've said, 0.25%. If you look at Tanzania, which is at about 0.5. So suddenly I think there's space to bring that number down, or that rate down.
And now, finally, before we take a break, let me just ask you this question, Robert. Perhaps then the conversation should be, should we address the law such that we give a window? For example, we say, if you're a company and you've been operating for at least 3 years and you're still in the loss territory, then definitely you should be paying minimum tax. If you're still between 1 and 2 years, then we should give you a breather. Do you see that potentially flying?
Unfortunately, I don't think that will fly. However, that is best practice. Actually, the way minimum tax is structured is that you should be given leeway to make losses. However, if you're in perpetual losses, then that is when minimum tax should kick in. So I do completely agree with you that that's the way to look at this law going forward. However, at present, it doesn't matter whether you've made taxes, you've made profits for the last 10 years, 1 year losses, you have to pay minimum tax.
Right, and that point by Robert Warero takes us to a short break on Business Redefined, where we are focusing on matters regarding the new taxation environment come 2021, which clearly has a raft of changes. In the second segment of this discussion, we'll be unpacking a lot more of this, including digital services tax and the Voluntary Tax Disclosure program. Stay tuned. Welcome back to Business Redefined. Tonight we are looking at the taxation environment in 2021 in light of the changes which have been brought forth by the Tax Laws Amendment Act number 2 of 2020, and we are joined by FCPA Robert Warero from KPMG to help us make sense of this. Robert, before we exit the discussion on minimum tax, there was an amendment to the regulation such that now a couple of entities are being exempted from minimum tax. If you look at, for example, the oil market retailers, the petroleum products retailers, I should say. Why is this the case?
So the thinking around oil marketing companies, or OMCs as they are called, is that if you look at their makeup, today a price of fuel, a litre of fuel is 106 shillings. If you look at that 106 shillings, about 60 shillings is tax. So if you want to tax them on that 60 shillings will be tax on tax. That's the biggest consideration, Julians. Then secondly, the margins that, especially in the open tender system, the margins that they earn are between 0.5 and 0.8%. So if you're asking somebody to pay 1% turnover and they're earning 0.5% margins, it doesn't make sense.
And we also have insurance companies included in this bracket of exemptions. I still can't make sense of why this is the case.
Well, it's because insurance companies are taxed under a separate regime under the Income Tax Act. So there's a different way of taxing these ones. However, I guess a similar case could be made even for banks. If you think about the banks, they report the gross interest income, then they have got an interest expense, and then you've got the net interest income. So if you look at some of these listed entities and look at the play of those numbers between gross interest income minus interest expense, so some differential is 10 billion. So if you're talking about 1% of 10 billion, you're talking about 100 million shillings every quarter. So it's going to build up, Julians. And I think there's reason to have another look at how these banks are also taxed.
Well, let's switch gears to talk about the digital services tax, which of course has evoked so much interest out here as far as who is affected. Clearly now we have the DST regulations. By DST I mean the digital services tax, and we are very clear as to who is being taxed in light of this. I was surprised to see downloadable apps in this segment, and maybe you can help us understand why this is the case.
Well, the whole idea about downloadable apps is because a lot of them collect data that is then monetized, in terms of people's patterns of usage things that are found online. So there is a question about when you monetize that, how do we get a portion of that revenue? And that's the reason why those apps have been targeted, in addition to so many other things if you look at the regulations.
Let's take a scenario which many Kenyans out here will throw at you. Let's say I'm selling my wares on a social media platform, and I make my payments or I receive payments on a mobile money platform, and there's no clear way of telling whether the remittances received are payment for goods or they are just P2P remittances, as they always are the case. Let's say I'm sending to my parents or something. How will we be able to now begin to dichotomize these two and be sure that we are netting only those transactions affiliated to digital services?
That's a good question. Excuse me. That's a good question, Julians. Number one, the definition of a digital marketplace is one where it's a platform that enables the buyers and sellers to interact. So the first question that we have to ask ourselves is that a digital marketplace, your Facebooks and what have you? And I think by definition, it is a digital marketplace. Number two, if you look at the regulations, they speak about services. So what service is being rendered there? And to the extent that we can isolate a service, then that will be subject to the 1.5% tax. Now, the question that you raised about sending money or P2P kind of payments, those ones would not qualify as a service by definition, and therefore would be outside of the ambit. However, I expect that the payment aggregators like Safaricom, will be appointed by Revenue Authority to collect this tax. And when they are collecting, then they'll have to define what comes from a digital marketplace and what doesn't come from a digital marketplace.
Robert, correct me if I'm wrong, but my sympathies are with these aggregators, because if you're looking at the telcos or you're looking at the banks, for instance, still the question becomes, how do they know, for example, today if I secured a service from you and I paid you whatever amount, whether it's 20,000 shillings, there is no clear way of getting visibility to know that this was actually for a digital service transaction?
Well, I think they'll have to trace those transactions and find out, does this come from a digital marketplace? And if by definition it does, then I think the preponderance will be, let's tax it and then figure out whether there's going to be a refund or not, assuming that we are not clear on that. However, I think the way the law has been defined is that the services are quite well enumerated in the regulations, and it's going to be very easy, I think, to identify those transactions and subject them to tax at the point of payment.
Allow me to throw at you a question I threw at you regarding the minimum tax. When you look at the rate of 1.5%, do you feel this is a fair rate in light of the digital services tax when you benchmark against peers in this region and across the globe?
Well, let's start by saying that peers is a bit difficult because not many people have brought digital services tax into their laws. However, if you think about globally, then I think 1.5% compares quite favorably. You're talking about the 6% in India, the 3% in the UK and France and what have you. So I think 1.5% is, I would say, a fair rate.
I see. And when you look at the targets being envisioned by Treasury and KRA in light of these new taxes, how optimistic are you as far as plugging in the deficit is concerned? If you look at the October numbers, we were hovering about 440 billion, which was punching below the capacity expected by this kind of time.
Well, I think, Julian, one of the things that we hope is going to happen, and I'm sure the taxman hopes is going to happen, is that the economy is going to pick up so that those lags can be recovered. However, I also think, and I think you are going to ask a question about voluntary tax disclosure, I think that is really the solution that Revenue Authority is banking on, because if people come forward and disclose their taxes, they make their payments or they make arrangements to pay, then suddenly that deficit will be plugged. However, like you correctly say, if you look at the October numbers that have been published, Revenue Authority is behind schedule, if I could say that, in terms of tax collections.
Robert, you preempted my next question. When you look at the voluntary tax disclosure program, are we being too ambitious with this, or what's your sense around how this could perform, especially in light of the historical performance? Because as you keep on saying, this is not the first time we're going through this.
Yeah, if you look at the last really successful amnesty that happened in this country, that was 2003, 2004, Revenue Authority did collect quite a bit of tax, and more importantly, they brought in new taxpayers into the tax bracket. Remember, at the end of the day, what Revenue Authority is interested in is expanding the tax base, the number of people who are paying taxes. So if you self-disclose today, the expectation is that tomorrow and the days to come, you will be paying your taxes. So my thinking is that this is definitely a good solution to our tax problem as a country. And certainly, I expect that Revenue Authority is going to be collecting a lot more in the months to come.
Robert, walk us through how this voluntary tax disclosure program works, because I understand that the waiver for disclosure in the first year is not the same as the second year or third year. Just give us a sense of how this looks like.
You're right, Julian. So the way the tax disclosure program has been structured, and by the way, I should add, it's been structured around the Singaporean model. So it's a 3-year kind of plan. If you self-disclose and make payments within the year 2021, calendar year 2021, then you are eligible for up to 100% waiver of the penalties and interest. However, if you make the disclosure but don't pay the entire principal tax in 2021, and say, for example, you pay it in 2022, then you're only eligible for 50% of the waiver of the penalties and interest. If you pay in 2023, then you get 25%. So there's sort of like a trade-off. The earlier you pay, then the better off you are in terms of the tax waiver, the penalty and interest waivers that you get.
Robert, as we wind up and as I get to know from my director whether we have the markets report or not, one of the concerns is that going into next year, even loss-making companies enter the tax bracket. And the concern out here from Treasury is that companies keep 2 sets of books. There are those who file the genuine books where they report a profit and they don't file to the authority, but then they cook books with losses, and then that is what they make public, and therefore their tax liability is subdued. Do you think there's an argument here from Treasury?
I think Treasury has a point, and my comment there is that there's no need to impact negatively all the taxpayers. I think there's a way that Treasury can select these fellows or smoke out these fellows who are cheating and go specifically for them, so that not everybody is suffering under the 1% tax, because I think that is quite punitive for businesses. So I think KRA really does have their work cut out for them in terms of tax cheats.
Final question, and very briefly, Robert, your outlook in terms of revenue mobilization in 2021?
It's going to be a tall order. However, I think as a country, we'll just make it.
Great. And that point by Robert Warero takes us to the close of our conversation on Business Redefined tonight, where we have been focusing on the taxation changes which are anticipated come January 1st, 2021. Clearly, a number of us will have to tighten our belts,